Today we'll cover the three classic awesome oscillator signals: zero line cross, saucer, and twin peaks. I'll give you clear testable rules for when a signal is valid and when to ignore it. No fluff, just conditions you can verify. First, what AO measures. AO compares a fast and a slow price impulse and shows the difference as a histogram around the zero line. Green bars mean the current impulse is stronger than the previous one. Red bars mean it's weakening. The zero line is your balance point. Above zero, the bullish impulse dominates. Below zero, the bearish impulse dominates. Signal 1, zero line cross. For a long setup, the AO closes above zero, a move from negative to positive territory. Always wait for the candle to close. The signal is valid only on close. The cross is more reliable if several prior bars were below zero, so you're seeing a real transition, not noise. For a short setup, the AO closes below zero, positive to negative. Again, valid only on close, and ideally after a period above zero. Skip this signal if AO whipsaws around zero with back-to-back crosses, or if the cross comes after an extended run when price is already stretched. That's often a late entry. Signal 2, saucer. The idea is a brief correction inside the impulse zone, followed by a resumption of momentum. Long saucer, strict conditions. 1. AO must be above zero. 2. You get 2 consecutive red bars, and the second red bar is shorter than the first. The pullback is fading. 3. A green bar appears after those 2 reds. 4. The signal is considered only at the close of that green candle. Short saucer is the mirror image. 1. AO must be below zero. 2. 2 consecutive green bars with the second bar shorter. 3. Then a red bar appears. 4. Valid on close. Quality filter. Saucer works best near the zero line but in the correct zone. Above zero for longs, below zero for shorts. If the saucer forms far from zero after a long move, probability drops. Signal 3, twin peaks. The idea is impulse exhaustion. The second peak in the impulse zone is weaker than the first. Long twin peaks, a double bottom below zero. 1. You have 2 AO lows below the zero line, and the second low is higher, less negative than the first. 2. Between the 2 lows, AO stays below zero. There's no interim cross above zero. 3. Confirmation comes when AO ticks up after the second low and the bar closes. Short, twin peaks, a double top above zero. 1. 2 AO highs above zero, with the second high lower than the first. 2. Between the highs, AO stays above zero, no interim cross below zero. 3. Confirmation is a bar that pushes AO down after the second high and closes. Quality filter. The pattern is stronger when the second peak is clearly weaker and the formation is close to the zero line. If AO crosses the zero line between the peaks, the twin peaks signal is invalid for this setup. Risk and context. AO measures momentum. It doesn't replace market context. Combine AO with a higher time frame bias or a key level. Use a simple risk rule, for example, risk no more than 1% per trade, and stick to one consistent exit method, a fixed reward to risk target, an opposite AO signal, or a trailing stop. Consistency matters more than perfection. That's the awesome oscillator in practice. Zero line cross for transitions, saucer for momentum resumption, and twin peaks for exhaustion. If you want more straight-to-the-point trading clips without the hype, hit subscribe.